Okay, let's unpack this. When I read the phrase "the Great Migration" in our source material today, my mind immediately went to nature documentaries.
Oh, yeah.
You know the scene? Thousands of wildebeest crossing the Serengeti, dust kicking up, crocodiles snapping.
The whole dramatic Hans Zimmer score in the
That's
background.
exactly. It's total chaos.
It is an evocative phrase, isn't it? But the Great Migration we're diving into today is a little quieter.
A lot quieter.
There's no dust, no crocodiles, and definitely no dramatic music. But the stakes, at least financially, might actually be higher.
That's it. We aren't tracking animals. We're tracking dollars. Billions of them. We're looking at this massive kind of structural shift happening with high net worth families. They're moving their money out of the investment vehicles most of us grew up with, traditional mutual funds, and parking it somewhere else. Now, usually when people move money, I just assume they're chasing a hot stock, right?
That's the common assumption. I need better return.
I got to beat the market.
Right. But what's so fascinating here is that this migration isn't about earning higher returns on paper. It's not about finding the next NVIDIA or Bitcoin. It is entirely about what the source calls tax efficiency.
Tax efficiency, which, let's be honest, sounds like the most boring dinner party topic imaginable until you realize what it actually means for your bank account.
Exactly. The source, which comes from Davies Wealth Management, argues that wealthy investors are realizing they are leaving serious money on the table.
And the kicker is, it's not because they pick bad stocks.
No. It's because the structure of the investment vehicle itself, the mutual fund, is essentially, well, leaking money.
Leaking money. That is a nightmare phrase for anyone with a portfolio. So here's our mission for this deep dive. We're going to put the heavyweight champion, the mutual fund, up against this challenger, the separately managed account, or SMA.
Okay.
We need to figure out why the source claims mutual funds cause this thing called tax drag. We'll look at the specific superpowers of the SMA, and we're going to do the math on when it makes sense to actually switch.
And the math is surprisingly clear once you strip away the jargon.
So let's start with the basics. Segment 1, the vehicle's defined. I think most people listening have a 401k or an IRA, so we've likely all used a mutual fund. But if you had to break down the actual structure for us, what is it?
Think of the mutual fund as a massive cruise ship.
Okay, I like vacations. I'm with you.
You buy a ticket, that's your share, and you get on board with thousands of other passengers. The captain is the fund manager. They decide where the ship goes.
Right, where to invest.
Exactly. You're just along for the ride. It's a community effort.
So it's pooling.
It's pooling.
Yeah.
And here is the key detail. You own a share of the ship, the experience. You do not own the engine or the lifeboats or the buffet.
Right. I own a slice of the pie, but I don't own the actual ingredients.
Correct. In financial terms, you own a share of the fund, but you do not own the individual Apple or Microsoft stocks inside it. And because it's a community pot, everyone gets the same tax treatment. It's designed for simplicity, low minimums. It works great for portfolios under, say, $500,000.
But if that ship hits a tax bill,
Everyone gets wet.
okay, hold that thought on the tax bill, because I know that's the juicy part. Let's contrast the cruise ship with the Challenger. What is a separately managed account, an SMA?
Well, if the mutual fund is a cruise ship, the SMA is more like a private yacht or maybe a custom-built car. The biggest distinction, and the source really hammers this home, is direct ownership.
Meaning?
In an SMA, you don't own a share of a fund. You actually literally own the individual securities.
So I'd log into my account and I wouldn't see Growth Fund A.
No. You would see 50 shares of Apple, 100 shares of Microsoft, 20 shares of Amazon, all listed right there in your name.
So a professional manager is still making the decisions buying and selling. But the assets are legally mine.
Yes. It's not a pool, it's your own account.
On the surface, that sounds like a tiny administrative detail, doesn't it? Like, oh, I own the share versus a share of the share. But the source claims this has massive implications.
It really does. It sounds trivial, but that legal structure changes everything about how you are taxed. It basically decouples you from all the other passengers.
Which brings us to segment 2, the tax drag. This is where the source starts throwing around some scary numbers. They mention that for high net worth families, sticking with mutual funds can cost them 1% to 2% of their portfolio annually.
That's the hidden cost, the tax drag.
That is huge. I mean, think about it. If you're paying an advisor 1% and the fund fee another 1%, and then you have a 2% tax drag, You're going backwards.
You're paddling upstream, and the most egregious example of this, according to the source, is something called unintended distributions, or what I call phantom gains.
This was the part of the reading where I actually got a little angry on behalf of the listener. This idea of paying taxes on money you never actually received. Walk us through how that's even possible.
It comes back to that cruise ship, the pooling structure. So imagine a bunch of investors decide to leave the fund. Maybe the market gets shaky, or maybe a lot of boomers are retiring and they need cash.
Okay, so they redeem their shares.
Right. And when they do, the fund manager has to pay them out. So the manager has to sell some stock to get the cash.
Makes sense.
And if the stock the manager sells has gone up in value since the fund bought it, maybe years and years ago, the fund realizes a capital gain.
Okay, standard stuff, sell high, pay taxes, no surprise there.
But here is the problem. You didn't sell anything. You're still in the fund. But by law, mutual funds have to distribute those capital gains to all the remaining shareholders. So even though you didn't sell a single share, you get a distribution.
And that distribution is taxable.
It's taxable. You get a tax bill.
That is wild. The source gave a specific example that really drove this home for me. They said you could buy a fund in, November?
Yes, this happens all the time.
You buy in November. Then in December, the fund pays out its annual capital gains distribution from trades that happened all year or even years before you showed up. So you get a tax bill in December for gains that happened before you even owned the fund.
That is the classic buying a dividend scenario. You are literally stepping into a tax liability that you didn't create.
It feels like walking into a restaurant, sitting down, and getting handed the bill for the previous table's dinner.
That's a perfect analogy. You're paying for the lobster the person before you ate, and this is where the SMA shines. Because there are no other investors in your account. There's no pool.
No one else's behavior can trigger a tax event for me.
Exactly. You are never forced to recognize gains because someone else decided to sell. If you don't sell, you generally don't pay capital gains. You decide when to pay the bill.
Okay, so avoiding phantom gains is a huge defensive move. But the source also talks about offense. Let's move to segment 3, the SMA superpowers. The first one they list is individual cost basis and loss harvesting. Now, harvesting sounds like we're on a farm. What are we harvesting?
We are harvesting losses. And while it sounds counterintuitive to want losses, in the tax world, losses are a valuable asset.
Because they cancel out gains, right?
Exactly. In an SMA, because you own the specific shares, the manager can see exactly which lots of stock are up and which are down. They can strategically sell the specific losers' stocks that have dipped in price to realize a loss.
And a mutual fund can't do that for me specifically.
No, the manager is just managing the whole pool. They can't sell your losers because you don't own individual shares. In an SMA, this tax loss harvesting can happen, constantly.
So they sell the loser, they book the tax credit, and then what? Just sit in cash?
No, and this is the clever part. They sell the loser and immediately buy a very similar substitute. So if they sell Exxon because it's down, they might immediately buy Chevron.
Oh, see.
You stay invested in the energy sector. You don't miss a market rebound, but you have harvested that loss for your tax return.
Okay, that makes sense for offsetting gains within the portfolio. But here's where it got really interesting to me. The source said you can use these losses to offset gains from outside sources.
This is a critical point. This is the aha moment for a lot of people. Let's say you sold a rental property this year, or you sold a business, or had a big private equity win. You have a massive capital gain sitting on your tax return.
And the IRS is waiting with their hand out.
Right. But if your SMA manager has been harvesting losses in your stock portfolio all year, you can take those stock losses and use them to offset that real estate gain.
Wow.
You can significantly lower your overall tax bill, not just the tax bill on your stocks.
So it's holistic. It's looking at your whole financial picture.
Precisely. It turns market volatility into a tax asset. When the market dips, an SMA manager sees an opportunity to lower your tax bill. A mutual fund manager, well, they just see a bad day.
It's like turning lemons into a tax refund. Okay, let's talk about superpower number 2, customization. The source brings up the concentrated stock problem. I feel like this applies to a lot of people in tech or corporate leadership.
Oh, absolutely. The company man or woman scenario. Imagine you work at a huge tech company. For years, you've been paid in stock options or RSUs. You are heavily, heavily invested in, say, Apple.
Right. Your salary, your bonus, and your savings are all tied to one company.
It's a dangerous concentration. The last thing you want is for your diversified investment manager to go out and buy more Apple.
Right. If that company tanks, You lose your job and your portfolio crashes. That's a double whammy.
Exactly. So with an SMA, because you own the securities directly, you can give specific instructions. You can tell the manager, build me a diversified portfolio, but do not buy Apple. Or no energy stocks.
You can't just call up your mutual fund manager and ask for that.
No. You can't write a letter to a massive fund and say, hey, could you skip Amazon for me? Thanks. They'd laugh you out of the room. In an SMA, it's a standard practice. It's just a restriction on the account.
The source also mentioned funding flexibility, this idea that you can transfer stock into an SMA.
This is huge. Let's say you have a brokerage account full of random stocks you've bought over the years. Some have huge gains. If you want to move that money to a mutual fund, you usually have to sell everything first.
Which triggers taxes immediately.
Boom. Huge taxable event. You pay the taxes, then you invest what's left. With an SMA, you can often just transfer those stocks in kind. You move the shares right over, no selling.
So no tax event.
Not immediately. And then the SMA manager can patiently work around those positions, maybe selling them off slowly over several years to manage the tax hit. It's a much more civilized approach.
Okay, that all sounds great. But we have to talk about the elephant in the room. Segment 4, the price tag. Because when I hear customized and personalized, I just hear expensive.
And you should be skeptical. There is a cost difference.
So lay out the numbers from the source. What are we looking at?
Mutual funds are generally cheaper. You're looking at expense ratios from maybe 0.5% to 1% for active funds, much lower for index funds, of course. And the minimums are low.
And SMAs.
The source says the average SMA fee is around 1.34% of assets. And the entry ticket is higher, usually a minimum of $100,000, but really more like $250,000 or more.
So 1.34% versus, let's say, 0.8%. That's a real difference. If I'm paying more, why am I doing this?
This is where we have to do the break-even analysis the source talks about. Yes, the headline fee is higher. Let's say you pay an extra 0.5% for the SMA.
Okay, so I'm down 0.5% right out of the gate.
Right. But if that tax loss harvesting and avoiding the phantom gains saves you, say, 0.5% to 1.5% in taxes every year,
then I'm actually up. I'm ahead.
you are ahead on an after-tax basis. The source argues that for the right investor, the tax savings don't just cover the extra fee, they far exceed it. You're basically paying a premium to get a big discount on your taxes.
So the fee is an investment in tax savings.
That's the argument. It's not about what you pay, it's about what you keep.
But the source says there's a threshold for this, right?
Yeah.
It's not for everyone.
No. The math really starts to work in your favor when the portfolio hits about $500,000. And once you cross the $1 million mark, it gets even more powerful.
Okay, so let's make this practical. Segment 5, the checklist. Who is this actually for? The source provides a specific profile. I want everyone listening to mentally check these boxes.
Okay, let's run through. First, obviously, investable assets. Do you have over $500,000 to invest in a taxable account, ideally over $1 million?
Check. And just to clarify, this is for a taxable brokerage account, right? Not your 401k.
Correct. Your money is in an IRA or 401k. None of this tax stuff matters. Those are already tax sheltered.
Got it. Okay, box number 2.
Are you in a high tax bracket? I mean, if you're in a low bracket, capital gains taxes don't hurt as much. But if you're a high earner paying 20% federal plus state taxes, this really matters.
Right. If Uncle Sam's taking a big bite, you want a shield. What's box 3?
Do you hold concentrated stock? Are you that company man or company woman we talked about?
And finally,
Transparency and estate planning. If you're the kind of person who really wants to see exactly what you own, an SMA gives you that. And for passing wealth down, managing the cost basis of individual stocks can be a huge tool for your kids.
so if you checked, 3 or 4 of those boxes, you might be the person the Great Migration is all about.
It's definitely time to at least ask some questions about your current setup.
Okay, so to wrap this all up, the big takeaway for me seems to be that mutual funds are fantastic until they aren't.
That's a fair way to put it. They democratized investing, which is great, but the rules of the game change when a portfolio grows. What works for a $50,000 portfolio often actively hurts a $2 million portfolio.
And the core philosophy of the source, this is what stuck with me, is the difference between the headline return and the real return.
Yes, what did the market do versus what did I actually keep? You can brag about beating the market by 1%, but if you gave back 2% in unnecessary taxes, you actually lost. The whole point is to shift your mindset to the after-tax result.
And here's a final provocative thought for you to mull over. The source mentioned the power of compounding these savings. It's so easy to shrug off a 1% tax saving. You think, 1%, who cares? But if you save 1% of your portfolio from taxes every single year, and you leave that money invested to grow,
Over 20 years, that is a massive, massive chunk of wealth. We are not talking about spare change. We are talking about hundreds of thousands of dollars, potentially.
It could be the difference between retiring comfortably and retiring luxuriously.
Or what you leave to your kids. It's the butterfly effect, but for your wallet.
The butterfly effect for your wallet. I like that.
It fits.
Well, we hope this deep dive has helped you look at your portfolio a little differently. Whether you're in a mutual fund and happy or realizing you might have some tax drag to fix, at least now you know what to look for.
And just a reminder, we are unpacking the analysis provided by Davies Wealth Management in today's source material. We are not financial advisors, and we are not giving you personal financial advice.
Always have to say it.
Thanks for listening, and we'll catch you on the next deep dive. See you next time.